Okay, guys, so today I'm introducing you to my business advisor, Paul Miller, Business by Design. We've worked together, Paul, for I think it's been over 3 years. I was saying 3 years, but I think maybe it's been.
I think it's about 4 years now, but yeah, it's in the same range. So we'll say
It's
under five or under. So
under 5, but it's been really important to me as I've grown my business to have really good strategic tax advice that helps me be strategic and save money and not give it all away and just be very thoughtful about it. And sometimes when you're us realtors, we're really freaking busy. Everyone's working 24/7. Like, we got to figure out ways to partner with the right people and get really great advice. So I am sharing Paul with you. So Paul, I'll let you take it away and just give us great advice that realtors can take away.
All right. Well, great. Thank you. Thank you for having me. And thank you for the time we got today. I know we have about 25 minutes here or so. So really wanted to focus in on a couple things for you, just to maybe start having you think or view about things about your taxes, maybe a little bit differently. First and foremost, I fully expect everyone on this call, all our clients hate this crap. Okay. So they hate anything to do with taxes, which I get. But the issue is, for most people, what you have to do come to the realization is that you're partnering with the government. The question is, at what level of partnership is it? And really, planning and managing your taxes is something that's a very important piece. So what I wanted to do today was maybe just give you a little bit of perspective about that. So just really quick, as far as Business by Design, we work primarily with small business owners and entrepreneurs. Our clientele are really small business owners and entrepreneurs, trying to teach people how to become and stay tax efficient. Within my staff, we have 22 staff, all but 4 are here locally in the Twin Cities. I have 4 full-time remote people. As I mentioned, our clients being entrepreneurs. We do talk about taxes, and we talk about tax a lot, but I'm going to preface this by saying we're not an H&R Block. We're not TurboTax. So when someone calls us and said, hey, can you help us with our taxes? We can, but that's really not what we do. So we don't really prepare taxes. We first develop a plan and a strategy around your business model. From that, doing your taxes is really just a task that comes with being in the tax system we have. So I've been doing this for over 25 years. And the one thing that I will tell people that I've learned being an entrepreneur myself, and learning about these types of things, is that what you probably need to start to think of if you want to get a different outcome when it comes to your taxes is you can't look at your taxes and an idea of preparing your taxes as a task. Like, there's a deadline, I got to go get something done. Your taxes are an ongoing thing. So we work off really a couple simple principles. Number one, your taxes are a multi-year event. They happen year over year over year. Your business, your self-employment happens year over year over year. So we don't want to just think about, we got 1 year done, or what do we need to do for this year? We got that done. Now we move to the next year. We want to start understanding we're working off a continuum. The other thing that we work off of, especially when we talk about planning, is we don't spend our way to prosperity. The reality is, if you make no profit, you don't pay tax. But the issue is that we all want to be profitable to be able to do other things with that profit. So we don't just try to spend our way down, spend profit down just for the sake of spending money. We want to ultimately be profitable. So when we think about that, we think about just a couple terms that come into the works of things. So we want to talk about what your marginal tax rate is, and specifically looking at how your taxes are filed. So I'm going to take a few minutes here and just show you a few things that I think are really important to understand the reason why. Why is planning for my taxes important? So here on the screen, you'll see if you file your taxes as a sole proprietorship, if you get your commissions paid you personally, and you're going to file a Schedule C, the top line of that Schedule C is just going to be your 1099 income, your 1099 IRS reported income. Then you're going to have your expenses. So let's say I had 130 of income, 30 of expense, 100 grand of profit. My net business profit on a Schedule C, I pay 3 taxes on that. The first is Social Security Medicare tax. Then I've got Fed tax and state tax. Okay. So that's a Schedule C sole proprietorship. Now, if you happen to be a corporation, which some of you may be, the top line of your S corporation tax return is your commission income. Then there's various ways that you take money from an S corporation and you get your profit at the end. We'll go over that in a minute here, what that's like. Either way, when we look at income you earn, if you're a sole proprietorship, that bottom line net profit. If you're a corporation, it's wages. You pay Social Security Medicare tax. Social Security Medicare tax is a 15.3% tax. This year for 23, the limit is capped at 160. Last year's 147. So if I was a Schedule C sole proprietorship and I made $200,000 of profit last year, the first 147 is going to be taxed at 15.3. Then from 147 to 200, that portion is 2.9. The 2.9 goes to infinity, basically. That's the Medicare portion of tax. Social Security is capped. That's per taxpayer. So if you're have a spouse, both of you have to reach that limit to stop paying the Social Security Medicare or Social Security tax. So Social Security and Medicare are talked about commonly as the self-employment tax. It's all one thing. So you want to think of it as the 15.3% tax or 15% tax. So when I generate income or profit, I got to pay that tax. Then I have to determine what my income taxes are. So using the example here, let's say I have a spouse, I'm married, filing joint, spouse's wages of 80. I take my business income. We have a total income on our tax return of 170. There's a term called, you might hear of adjusted gross income. That's more used in the world of banking and things of that nature. But more specifically, line 15 of your tax return. Probably don't have a 22 return yet, but if you look at your 21 tax return, and maybe after this session, go look at your 21 tax return, line 15. That is your taxable income. That number is what you pay income tax on. The profit from your business is what you pay Social Security Medicare tax on. So they're two different numbers. Now, why this number is important? Because what we try to make sure people understand in the understanding the why do we, like, what is important? Let's say we're approaching through the fourth quarter of last year. And we're like, hey, should I spend money on this? Or what if I bought this computer? What's that going to save me in taxes? Everything has to do with your marginal tax rate. So your marginal tax rate, and these are the tax tables. Now there's 4 different tax filing statuses. These are the 2 most common: single, married, filing joint. So again, using my example here, if I was 122 of taxable income, I would look at my tax table here and married, filing joint. The first 22,000 is 10%, 22 to 89 is 12%. 89 to 122, that portion of income is taxed at 22% there. We live in a progressive tax system. Each portion of income is progressively taxed higher, okay? Not all of it. So that's one misconception people have. When I'm in a 22% bracket, not all my income is taxed at that. Just the striation from 89 to 122. So the last dollars I earn are going to be taxed at 22% for Fed. Here I'd have about 6.8 for the state. And then I could have my 15% Social Security tax. All right. Now, I don't have to be a rocket scientist to figure out if I'm adding that up, that's about 44% in taxes. And for people, when they start generating profit in the world of self-employment, and as they start to generate more and more profit, what they do is their taxes also creep up on them. And they go, holy cow, how am I paying so much in tax? This is a math equation. It has nothing to do with what you did, okay? So by default, what ends up happening for many people, in using the example I had, from 89, let's just say 90,000 to 122, the last $32,000 of profit I earned was taxed at 22% Fed, 6.8 to the state, 15 Social Security, okay? Now, when you maybe started in real estate, and got your license, no one really signs up for a business model that, hey, you know, that model, I'm going to pay half my money in taxes. Sign me up for that. That sounds like a good deal. Okay. This is where I'm saying that you have choices of how you decide how much or how little of a partnership you have with the IRS when it comes to your tax liability. Now, we like to talk about marginal tax rates because this is the most important element of your tax planning. Now I'm going to give you a little spin on this just to give you this concept. What happens for most people when we talk about marginal rates, if I was at 44%, I said, I'm going to buy that computer that I was thinking about buying, spend $2,000 on, I create a business expense. My profit drops, I'll save 44% of that, roughly $900 in taxes. If the number went the other way and I had 2,000 more of income, maybe another commission came in, I wasn't expecting, all of a sudden my income went up by $2,000, it's 44% the other way. The pendulum swings the most violently on the last dollars earned. The last dollars you're earning, that's the ones we can plan around. Those are the dollars available that we're deciding, should I buy this? Should I do this? Should I do that? Understanding this for most people is important, because if you miss a deduction, let's just say that you have a medical expense and you didn't have an HSA to pay for it, and you're just like, it's a copay, it's $100 out of my pocket. Okay, I'm not going to worry about that. I'm not going to write it off. $100 expense that's non-deductible is really, in this example, $179. You have to make $179, pay tax. That's how you get $100 post-tax. The difference between pre-tax and post-tax is huge. And people kind of get this distorted. You have to start making that correlation. If I generate profit, what am I paying tax on the last dollars I earn? Because that's what the decisions are I'm making as I drive that. Now, I like to give this example. I use the gas station example a lot because I think it correlates to people when we talk about pre-tax and post-tax. So I've got 3 young daughters. Say my wife and I are leaving the home at the same time in the morning. She's driving our kids to school. I'm leaving my home office to go to my office here in Edina. We stop at the gas station. And let's just say gas is, I'll just round it, $4 a gallon. Okay. So gas is $4, costs $4 a gallon. I can earn $4 and buy 1 gallon of gasoline to put in my truck. My wife, on the other hand, the sign says $4. It's not correct. It should say more like $7. It costs us $7 to buy a gallon of gasoline because it's non-deductible. We have to earn 7, pay 3 in tax, and that's what we get 4 left. That's how we pay tax. Okay. The reality is, for most people, everything that's non-deductible has a higher cost. If you were wondering, generating profit from your business, and you have some specific goals or objectives with your real estate business, like, and I like to generalize things to say, maybe I want to reduce debt. I want to save some money in my bank account. I want to make an investment, maybe into a rental property, pay for kids' college education, do something fun with the family, whatever it is that you might want to do. All you need to know is that most people's goals and objectives are non-deductible. So therefore, the profit you need to earn is the real dollars you need to earn is much higher than that. So for many people, and this is kind of continuous across all taxpayers we see, for most people, when they're in these low cost tax brackets, that's their, what I say, their money they eat and sleep in, their basic living expenses. When you actually have money to achieve some of those goals, maybe you're like, hey, I can pay off some debt now. I can save some money for a down payment on a property. I can make an investment. We can do something else. Most of the time, it's going to be with higher cost tax dollars. Now, I'm not saying all that to bum you out, okay? But I'm also not saying it to confuse you. All I'm trying to do is give you the context of why planning is important. Most people try to chase saying, well, I don't want to pay taxes. Well, who does? Okay. But you need to understand the impact of what you're doing. What is the model you have? And we need to understand our marginal tax rate to decide, should I do this or should I do that? So that's one of the key things we try to focus on first in helping people understand their marginal rate and the cost taxes have. Now, there's also different tax brackets for people as an investor. All right. So this is an example of what the income tax rates are. In the middle column here has the income tax brackets. On the far right, though, you can see the capital gain rates. Generally speaking, historically, capital gain is always less than income tax. All right. So in our world, if we want to create, as we say, post-tax net worth, I want to have money after taxes are paid. What do I have as dollars A worker and an investor starting at the same point, a worker can never catch an investor, okay? Because investors pay less in tax. So when I generate my net worth from my work, my energy, my effort, I'm going to pay a higher tax rate than if, let's just say, I was fortunate enough to have inherited $10 million and I can invest that and I earn my income off capital gains, okay? Understanding what you're trying to do more than likely is take profit from your business and switch that over to saving money, investing money to become an investor is part of the strategy of how you start to effectively lower your overall tax rate. So it's not always about just spending money, trying to lower the taxes, but it's also about trying to utilize capital gain rates and understanding there's a lower rate when you invest as a capital gain. Now, there's often questions that people will have about entities, okay? And we can go on for a long period of time about talking about various entities. I'm just going to skip over a couple things and just to show you really in the world of business, how you're organized. When you go get licensed and you're starting to generate real estate commission, by default, you're a sole proprietorship, okay? You get your commission paid to you personally, that's a sole proprietorship. Sole proprietorship is the most expensive form of business when it comes to taxes. And if it wasn't, everybody would be one. So by default, though, as a sole proprietorship, if your profit, and I'm going to generalize, is probably 40,000 or less, it might be an okay business model for you to operate out of. You're limited on what you can do for planning. It's really, here's what I make, here's what I spend, here's what's left. Whatever is left, I try to manage it with business expenses. That might be okay. Now, if you're exceeding that, more than likely, you probably would be needing to look at S corporation. Now, what an S corporation does, without going into detail of things, primarily an S corporation compared to a sole proprietorship, S corporations tackle the self-employment Social Security tax. So a S corporation, generally speaking, will pay about 65%, maybe sometimes 70% less in Social Security Medicare tax than a sole proprietorship. Now, that's not magic, all right? There's reasons and logic of how that works, and there's a bunch of steps to take, but that can be something of value for people when they're considering like, hey, I'm going on my path, I'm making more income, maybe I need to be structured as an entity. So when you become a corporation, here's what happens. People use corporations for one of two reasons, and sometimes both. One is tax planning, two is asset protection. As a real estate agent, you're really not incorporating primarily for asset protection, it's mostly tax. So I create a company, my name, I get a new name, a tax ID number. I create an alter ego separate from me personally. I then have my commissions assigned to that corporation. Now, the state of Minnesota will allow you as a real estate agent to assign your commissions to a corporation, as long as that corporation only has one owner, and that owner has to be licensed. So your commissions can be assigned to a corporation. Now, the corporation you have earns your commission, not you personally. Then you become an employee of your own corporation, and that's where the structuring takes place. So we've got sole proprietorship, the default form of business. People typically will migrate to something using something along the lines of a corporation, S corporation. And then we have a C corporation. Now, again, for this conversation, not really warranted. C corporations are typically larger companies, private investment, et cetera. So in the world of tax, there's three business models primarily: sole proprietorship, S corp, C corp. Sometimes then people will talk about LLCs. Now, to confuse the matter even more, LLCs don't have a tax status. So LLCs are created at a state level, not the federal level. So the IRS does not have an LLC tax return. There is no such thing. So what usually happens, I see if someone says, hey, I'm an LLC, they've created a company, they've got a tax ID number and a business name, they've got this alter ego, but when I go to create that tax ID number, the IRS will put me in the camp of sole proprietorship. A one owner LLC is by default a sole proprietorship. Now, I could, as an LLC, choose S corp status or even C corp status, but I have to forcibly choose that. By default, the IRS is going to put me in sole proprietorship. So we will see people that have taken a step of creating an entity but they haven't chosen the proper tax status. So that's my only thing with an LLC. What you're going to want to do if you are an LLC, want to make sure you're in the right tax status. Should you be sole proprietorship? Should you be an S corporation? That's pretty much going to be the deciding factor between the two. I'm going to skip over a couple of things here just due to time. I want to jump to business expenses. I'm going to cover, actually at this point, what I'm going to do is cover one thing, and then I'm going to open up to questions. Kind of want to really respect that fact that you all probably have some questions on things. Business expenses, people will ask, how long do I need to keep records? You know, generally speaking, the IRS can go back 3 years from the date of return is filed. So that's a 4-year window. We tell people 7 years because there is some issues, some situations where they can go back a little bit further. So we want to tell people 7 years of records. Now, a credit card, if I put everything for my business on a credit card statement is not evidence enough. You would still need to keep receipts. So sometimes people were mistaken thinking like, hey, I've used this credit card exclusively for business, should be good. You still would need to keep the actual receipts, and electronic receipts are more than sufficient. You do not need to keep paper receipts. Now moving into business deductions, and I'll open for questions on this. So the IRS has a definition of what is a business expense, right? This is technically the IRS's definition. It's what's considered ordinary and necessary for carrying on a trade or business, which really just boils down to, if you spend money on something, how is it going to help the business become profitable? If we're going to spend money on something, how does it make the business profit? Now, this is your typical chart of accounts that we'll see for people as in real estate, all right? The items I've highlighted here are typically going to be where the most questions come from on people when it comes to what could I do? And one of the things I'll point out here is like on auto. So for last year, your auto expense, there was 2 different mileage rates that were adopted. You would need to break your mileage down by 2 halves of the year, January to June and July to December. Most people in real estate will choose the mileage deduction just due to the number of miles that they drive. For 2023, it's bumped up to 65.5 cents a mile, but that's most typically going to be the mileage deduction. Now, if I choose mileage, that's the deduction I get. If I choose depreciation and actual expenses, usually happens where someone would have a large vehicle deduction thing, as we like to say. So someone might say, hey, I'm going to go buy a SUV and get a large deduction. Without going through the detail of this, what ends up happening is I take the cost of that vehicle and I can offset it against my profit. And then I'm on actual expenses, gas, oil, maintenance, repair, insurance. So there's 2 different methods you can choose, mileage or actual expenses. More than likely, you're going to use actual expenses if you have a vehicle over 6,000 pounds. That's pretty typical of what we would see. So if you have a larger vehicle, more than likely you've adopted a different type of depreciation, and that gives you a better end result than mileage. A couple other things I want to mention here also. Gifts. We see this mistake a lot. Client gifts are limited to $25 per person per year. If you're representing a couple, that's $50, like a spouse with an individual and their spouse, it would be $50. Entertainment is non-deductible. So if you do tickets to an event and give them to someone, you're pretty much going to be limited to the $25, regardless what the face value of that ticket would be. Otherwise, it'd be a non-deductible item. But client gifts are limited. More than likely, you'd want to skew that more into something that's more by marketing promotional expense, putting a logo on it, using your own branding. Then it is a marketing promotional expense. It's not a gift. And that's why you'll see people that distinguish between the two, doing things that are branded, with their business. Business meals have changed from a couple of years ago. So all business meals are 50% deduction. You take a client out for dinner, lunch, breakfast, whatever, it's a 50% deduction. Just remember, there are some things that are 100% deduction, and I can provide these slides for you just so you can use them as context. But if you do food for like an open house, where you have food for, there's a marketing presentation, those are things that are 100% deductible. So more than likely, when you categorize your expense, you'd probably have an expense for 50% and you have a 100% category. So client events, open house food, that type of thing is a 100% deduction, shouldn't be misconstrued as the 50%. Reminding you of one thing for last year, there was still a COVID thing that kind of spilled over. Meals with clients last year, if the meal was provided by a restaurant, it's 100% for last year. So that ended in 22. That was a COVID thing for 21 and 22. Meals provided by a restaurant were 100% deductible on your 22 taxes. So you want to make sure that you're indicating that and getting that deduction. Okay, I know we're almost at time. I've got some more things to run through. Kelly, it's up to you. Do you want me to answer questions for people, or what's your time frame?
Paul, are you done? You can go a little over and then we
Okay.
can open it up to a Q&A because I think that's so relevant and good what you were just talking about.
Okay, no problem. I'll just run through. I got about 5 more minutes here. I'll run through.
Love it.
Another item that you should make sure of that you're using is business use of home. More and more people, majority of our clients have business use of home that they're using. The definition for business use of home is at the box at the top. You can see your primary administrative duties are performed out of that space. The space is exclusively used for business. Now, there's a difference if you're a sole proprietorship, Schedule C, versus a corporation. Okay, there's kind of 2 different ways to handle it. But the benefit of doing it is that every time you leave your home, those are business miles. All right, so we want to define business use of home where, hey, that's where I kind of run my business out of. I personally have that. Run my business out of my home. Doesn't mean you can't have another office, right? I have another office, but I use a business out of the home. Every time I leave my home, those are business miles. It also helps allow me the opportunity to expand deductibility of things like percentage of utilities, internet, maybe home security, things along that lines. A portion of those or some of those costs can then be a deduction. So it's something you want to make sure you can think of. And you can definitely indicate that yet on your 22 return. Hiring people, we see this a lot when people hire other people, whether they're employees or independent contractors. The general sense of this is that for most people, if you're hiring someone who's more, I'm going to say just administrative tasks, that's going to be a W-2 employee situation. If you hire someone, you can consider 15 to 20% above what you're paying them is your cost just to hire them. That does not include benefits, has nothing to do with any paid time off or fringe benefits. It's about 15 to 20% is the taxes and the costs on top of that. Someone who's an independent contractor, if you hire someone as an independent contractor, they're really running their own business. Okay, you would 1099 them, they run their own business. And so if you are concerned about that, you should just make sure you're clear. If you're paying other people, are they truly an independent contractor? One group of people that you should also consider, though, paying as employees should be family members. So this is a common strategy that we will talk about and use about income shifting. So for last year, it was about 13,000. It's about 13,700 this year. Every individual can make about 13 grand and pay no income tax. All right. So that's our basic premise. Now, let's say my daughter, which she does work for me, does work for me. I pay her a wage. It's a deduction to me. It's income to her. If she makes less than 13 grand overall, she pays no tax. So instead of me paying tax up here, I'd rather shift the income to her. So let's say I pay her $10,000. Deduction to me, income to her. I put it in a bank account in her name. Now I go one step further and we talk about this. I use her pay then to fund a Roth IRA. So my daughters all have a Roth IRA. So we use that Roth IRA as a savings account for potentially future education costs. Roth IRAs, you can use them for education without penalty. So basic premise is this. I pay my daughter, let's say over the course of 10 years, I funded a Roth, $5,000 a year, let's say over 10 years. I got 50 grand of principal in the Roth. Let's say the Roth is worth 70 in value. I can take the 50 for whatever I want, doesn't matter. The earnings, the 20, I can use for education without penalty. So Roths are a tremendously flexible thing to help assist parents for future funding needs for their kids as time moves on. And it's an opportunity, though, where most kids are not able to fund the Roth IRA because generally they don't have wages. That's why kids don't have that. So we actually put the Roth IRA in front of things like education savings plans, or any of those other kind of things, because it's a great tool to use, but it starts with this idea of paying my kids from my business. Now, depending on how you're set up, if you're a sole proprietorship or corporation, it's slightly different process. We just need to verify the kid's actually done the work. It's a reasonable wage. The kids get the money. And basically that's going to be your compliance items, run them through payroll. And then that's a very common strategy that people use to help save for future costs. Could be secondary education, could be other things down the road that people might want to do. It's a very common strategy that people use. Last couple of things, and then I'll take questions. Last couple of things with your taxes coming up here before filing. Make sure you consider if you can max out your HSA. Your HSA is, if you're eligible, these are the contribution limits for 2022, depending if you're an individual plan or family plan. There's different limits, but you should try to max fund that HSA if at all possible. You have until 4/18, April 18th this year is the filing deadline. Because some holidays, government holidays. So 4/18, you have until to max your HSA. So that's setting money aside to pay medical expenses pre-tax. Your HSA funding is the first priority of pre-tax funding before retirement accounts. We say you should always try to max out your HSA. If you don't know if you're eligible for an HSA, you need to check with your health insurance provider. The type of health insurance plan you're on determines if you can contribute to an HSA, all right? If you can, then you want to try to max that out for 22 and maybe also then start considering your funding for 23. Everything you put into that HSA is a tax deduction. Now, HSAs are not a use it or lose it thing. So I can put money in, I don't have to spend it all by the end of the year. So don't get confused by that. But it's a great way to put away dollars for medical expenses. Remember the copay I said, if I was just saying, hey, there's a $100 copay, I'll just pay $100. It's probably not $100. For most people, it's like $150, $170. Using the HSA, it's $100. So paying for medical expenses pre-tax is a big item. The other one that's still available for you would then be contributed to retirement accounts. Again, based on if you're a corp or if you're a sole proprietorship, there's different kind of due dates, but more than likely, you could fund an IRAs or Roth IRAs. You have until April 18th this year to fund. SEPs, if you want to fund a SEP contribution, you have until the due date of your tax return. So with an individual return, 4/18, with extension 10/15. Corporations, due date is 3/15 with extension 9/15. So you have some period of time to decide if you want to take money from this year and maybe put it towards a retirement account for last year to help reduce your tax liability, the ending tax liability. You have yet some time to do that. Okay, questions? I know I ran through a lot of those things pretty quick. What questions can I answer for people?
Thank you, Paul. That was awesome. And we're going to save this too. But yeah, anyone have questions about this? There's been some of the things like guys, he went over about like my boys, they do a lot of stuff and running for the business, lock boxes, open house signs. Like Paul's helped me figure that out. Writing off a portion of the house, some stuff like that people know about, but there's just a lot of strategic stuff that I feel like you've helped me with. Thank you, Paul. Who has exact questions before we let Paul get back to work?
How do you know it's going to work?
Well, I'm assuming in February you're a busy guy right now, which I'm surprised you're even on with me. So thank you. Okay, I don't know that we have any questions, but people know where to find you. Business by Design, Paul Miller, guys. My business advisor and has helped me a lot with tax strategy. So Paul, thank you.
One thing I just want to address, there was a chat I just opened up. So there was a question about what's the best way to pay yourself. And I want to answer that just really quick. So one of the things that you want to do when you talk about paying yourself, whether you pay yourself a wage from your corporation or sole proprietorship profit, that's the most expensive form of income. There are other ways to take income. Now, again, this is a little bit more detailed conversation, but you need to find other ways, like possibly having, if you're a corporation, pay you rent. There's royalty fees. There's other things that you can do where you're not exposed to the Social Security tax. So that's the key thing, is really taking a look at what you're paying in Social Security Medicare tax and finding other ways to pay yourself from the business. Now, to do that, more than likely, you're going to need to be in a corporate structure. And then the other question just came in was, do you have receipts for all your purchases of a credit card? So again, if the credit card charge is not going to be obvious, more than likely, you're going to need a receipt. Here's what you're probably finding for most of your receipts, and people get kind of hung up on this, but it's actually, I think, pretty straightforward. Most things that charge on your credit card, or many things today, have some kind of billing or invoice. So you have somewhere else to go to get that invoice that you're being paid. If it's the walking around stuff, like, hey, I'm buying gas, or I'm walking into Target or Sam's Club or something like that, those receipts you're going to need to keep, because obviously those could be both personal and business. So you'll need to have the substantiation. The burden isn't on the IRS to show you it's not. The burden is on you to show you it is deductible. So if there's any question, the standard answer would be to keep your receipts to align with your credit card statements if you ever got called out from the IRS. Okay.
And at some point, guys, you're at different levels in your business. Like I used to do my books. Now Paul's company does all my books, right? So Joy is in charge of, she has all my credit card statements. She knows if it's, photography or whatever. She knows the companies that we're typically doing and what categories they go into. So you could also share that with your bookkeeper if you're at that point or you get to that point.
Absolutely. So with that, thank you all for your time and attention today. Hope you have a great year, and we'll maybe chat with you soon.
Thank you, Paul. Appreciate it.
Take care. Okay, no
Bye,
problem.
everyone.
Thank you. Okay, bye-bye.